Hey, I appreciate you tuning in to another video from Netpicks. And in this one here, we're going to talk about the Ichimoku indicator. Before we get started, I want you to take this download, and it's about options trading. And diversifying your approach to trading, it's never a bad thing. And you might actually find yourself preferring options to anything else. Anyways, the link is above and below in the description if you want to grab it. So let's talk about this indicator. And in a way, I think it's kind of powerful. It shows momentum, it shows trend strength, and possible support and resistance levels of any asset that you're trading. And it uses 5 moving averages, and part of the calculation produces a cloud, and that represents potential future support and resistance areas. Now, 2 of the averages, they are used to compute the cloud. And the settings are the 9-period moving average, 26-period average, an average of those 2 averages, and a 52-period average. The cloud itself is considered potential support and resistance zones. And when below the price, we have an uptrend. When the cloud is above price, we're looking at a longer-term downtrend. But before we trade any indicator or anything really, we have to understand more about it. So let's talk about what these lines are. So as we talked about, the lines are averages. And for our purposes, we're not going to cover the lagging span line. And that just plots the closing prices of the previous 26 periods. And that would be beneficial for traders who want to compare previous trends with the current trend. But we're going to ignore that. Let's talk about the conversion and the baselines. And these 2 lines are the present time, where the conversion line, it shows the middle price of the previous 9 periods high and low. Okay, so the average. The baseline, it's a longer one, and it represents the middle price of the previous 26 periods high and low, the average. And remember, most moving averages were calculated using the closing price. This is high and low. Now, both of these lines, they're analyzed just like any other moving average. And for those that believe that moving averages act as support and resistance, you can consider them as such. Now, the crossing of the averages and the price relationship to the averages represents trend and momentum in the market. So both the base and the conversion lines are considered support and resistance. The crossing of those averages indicates momentum, and the space between the line can actually gauge momentum strength. If the price is trading above both lines, we're looking at an uptrend. Price below the lines, downtrend. And you can see that just with that basic understanding, and if you know how moving averages work, this indicator is not as intimidating as it looks. So how does it work? Well, the cloud itself, that's probably the most recognizable part of this indicator. It has a fast line, a slow line, and in the middle, we have some shade. So the fast line is the middle price that's calculated using the conversion and the baseline. The slow line is the middle price of the 52 periods high and low. These calculations are shifted 26 periods into the future. For that, think of displaced moving averages. Okay, it's pretty much the same thing. The cloud is going to show us the longer term trend direction as well as potential support and resistance zones in the future. So you can see a red cloud indicates a confirmed bearish trend, while the green cloud indicates a confirmed bullish trend. And of course, you'd only take trades in the direction of the cloud if you are primarily a trend follower type of trader. Prices that are above the cloud would only have you exposed in long trading positions. When prices trade below the cloud, you look to be bearish. The crossing of those lines, the conversion and the baseline, that indicates momentum direction. At times, it's going to be against the cloud trend direction. So think of counter trend trading. So how do we set it up? Well, I use TradingView, but a lot of charting platforms are going to have the indicator as part of the package. And just simply apply it to your chart just like you would any other technical analysis tool. And once you apply it, you could alter the settings. Just like with most indicators, it doesn't matter what you trade. But for me, oftentimes the default settings for anything are acceptable. So how do you trade it? Well, now we get the building blocks of it. So you should have a fairly good idea of how you can trade it. So let's break it down. We pick our bias. Since the cloud is the first thing you're going to notice on these charts, let's start with that. So remember, a price that is above the cloud is bullish. The price that's below the cloud is bearish. The color confirms that bias. So this is a day trading chart of Bitcoin, just using the standard settings as I mentioned. And at any time, you can glance at this chart and know exactly what strategy to implement and the direction to trade. And I'm a huge fan of making things as objective as possible. For cautious traders, you may want to consider using half of your usual risk percentage until a confirmation of the trend has been shown, and that is the color of the cloud. So now we know bias. Let's use the conversion and the baseline for momentum directions. Now keep in mind, momentum and trend are different things. And conservative traders may only trade when the momentum is in the direction of the overall trend. Let's break it down a little bit cleaner here. This is going to be a Forex chart, swing trading, daily time frame. And it's going to show potential trading signals depending on your trading plan that you choose with this indicator. So the lines have crossed here. The price is on the bottom side of the lines. So this is bearish momentum, and that could be a trade entry. So here, momentum turns bullish, price enters the cloud, and that signifies a possible transition period. You could exit trades here, as we could be looking at a possible trend reversal. But here, momentum turns back to the downside. Price is below our conversion and our baseline, our present lines, and has broken to the downside from the cloud. That could be a short trade entry. Here, bullish momentum. And if you just read price action, you're going to see higher lows that are being put in. That is bullish. The momentum's up. Price breaks the top of the cloud for a lower risk profile trade for this bullish signal because we need confirmation of the trend. Here, possible potential support zone. And I say potential because we never know if something's going to be support or resistance until it's tested. Now, aggressive traders, they may take long trades while the cloud is still red. And that's why I said a lower risk profile. If you're more of a conservative trader, wait until the cloud's green and then look for a pullback in price for long trades. What about stops and targets? Before you enter a trade, you have to define the risk that you're going to take. And I prefer using the ATR for all my stops. But let's consider our initial stop loss just using the indicator. So the first short trade on the left would have the stop loss location around the top border of the cloud. And that's possible due to the contraction of the cloud in that area, because you can notice in other areas the cloud gets bigger, which would make it a larger risk. So if it's too wide, our position size may be too small, or depending on our market, we may not have the capital that's required for that particular trade. The second location, using the high of the baseline, as it may act as potential resistance if price retraces. And the last location here is below the baseline as well. Well, what about profits? Well, if you're a trend follower, you're not going to have a profit target because you're trading until you see a transition of the trend direction. So if you understand that, you may hold a trade until price retraces back inside the cloud, as that's going to show a possible trend change is forming. So if your trading plan includes always being in the market, you could actually exit a short trade and enter a long trade when price breaks the top of the cloud. Now, short-term traders, they may decide to use price structure as targets, previous lows and highs, or even a multiple of your risk. 1, 2, 3 times your risk. So do I think it's worth considering? Well, if you believe, like I do, that an objective approach to trading is going to help you stick to your trading rules, it's not a bad option. The visual nature of the cloud, it tells you at a glance the bias that you should have in the market. That's a bonus right there, because most people are just in, out, in every direction, right? Over trading. The conversion of the baselines, that's going to show you short-term momentum for and against the longer term direction of the trend. You do have several take profit options, and that includes an always in trading approach. You're always long or you're always short. As with all trading systems and any strategy, you have to do your proper testing. You have to use a written trading plan. And really, at the end of the day, understand that the risks involved in trading are great, especially if you're just winging it. Thanks for watching. Hit subscribe, and we'll talk soon. Any questions, put them in the questions below, the comments below there, and I'll answer them. Thanks.